Hello everyone and welcome back to the channel. If you are studying microfinance in banking and rural finance, then today's topic is absolutely essential for you. So today we are going to explore a very important concept in microfinance, that is delivery models in a microfinance. So we will understand what are the delivery models, why they exist, what are the different types and which model works best for whom. So let's dive in the stay till the end, and because the comparison tables and long lasting stay so going on really useful for the exams and interviews. So first, what exactly delivery models? Delivery models refers to the mechanism, or in simple words, the methods of channel through the banks and microfinance institutions, also called mutual fund institutions, deliver financial services to their clients. So, who are the clients? The clients are low income individuals, poor households, and poor people in rural areas and semi urban areas. The people who often do not have access to the traditional banking systems. So the keywords here, the efficiently and substantially. It's not just about the giving alone, it's about the doing away a cost effective, scalable and long lasting. Think think in that way, even if a bank wants to help to the farmer in remote areas or village areas, it cannot open a branch everywhere. So it's not possible to open the branch in the area that where there is not easily connectivity. So they need a smart delivery models to reach the farmers. So these models are bridge between the financial institutions and unserved population. Objective of delivery models. So now we know what is the delivery models, and let's understand why they are designed and what are the objective for that. There are four key objectives for the delivery models. First, number one, reduce a transaction cost, reaching to the remote clients and for the inexpensive physical travel or paperwork manual processing. It's all this is the cost for the money. So goods delivery models cuts this cost significantly. For example, using a mobile technology instead of the doing paperwork or manually. So the second number is improve outreach. There's who purpose of microfinance financial inclusion delivery models are designed to reach maximum number of low income clients, especially in rural areas. There are no connectivity and traditional banking system on that area. So third one is the control risk. Lending to the low income client without collateral is a risky. So the delivery model includes a system like a guarantee, peer monitoring and regular repayment schedules. So at that time, they reduce the risk and defaults by the client end. And fourth one is the ensure timely credit. A farmer needs money before a sowing in a season. So at that time, the small business owners needs the funds before the festival seasons. So at that time, goods or delivery models ensure that the credit borrowers are exactly right time, because the delayed credit can be harmful. No credit. So now we discussing about the types of delivery models. Now let's look the types of the delivery model. There are the several models used around the world, but the focus is on the five most important models which is used in day-to-day lives. First one is the SHG model or self-help group model. Second one, Grameen Bank model, which is organized in Bangladesh. Third one is the individual lending model. Fourth one is the BC model, business correspondent model, and fifth one is a MFI-Bank Linkage model. So each model has a own approach to own strength and to use the cases. Let's explore the each one. Let's start with the widely known the model in India, the self-help group model or SHG model. So here the how works. A small group, 10 to 20 people comes to the group, and usually women from the same village comes together and self-help group. Every month, each member contributes a small amount savings to the common pool, and after doing the regularly savings, after the 6 month, the group build a track records and trust. At that point, the group becomes eligible approach to the bank loan. The bank lends to the entire group not individually separately. The group manages the money and lends its own members and basis on the needs. So how it works, because the peers pressures and social accountability, if one member defaults the entire group is affected. So at that time members monitor each other, and this is the called peer monitoring and drastically reduces the risk and non-payment. In India, model is strongly promoted by the NABARD, the National Bank for Agriculture and Rural Development, through the famous SHG bank linkage program. The SHG models is especially powerful for the women's empowerment, building to the savings habits and providing the credit history those whoever had one loan. The second model is the Grameen Bank model. It was created by the Professor Muhammad Yunus in Bangladesh in 1983. The Professor Yunus was so committed to the helping to the rural poor, won who Nobel prizes in 2006 for his work in microfinance. It's a truly inspiring for us. So the Grameen model also used to the group-based approach, but very specific to the structure. Here is the step-by-step process. So let's see the how Grameen Bank model work. From groups, borrowers from small subsidiary and solicitary groups are exactly 5 members. So the members are from the same community and each personally. So then second, the training before the receiving to the any loan, the group goes to the through training sessions and on the financial discipline and loan usage to the and repayment. So third one is the initially only 2 members and 5 members group receives the loans. This is the crucial steps, and the other third one is the watch and wait. The monitoring and the entire group monitors to the where the 2 members repaying and on the time. If the default and remaining members will not the loan. Expand the credit. Only after the successful repayment, the first 2 members and do the next members gets the loan, and the creates the chain accountability. The beauty of the models, the group itself, the collateral and no physical assets needed. And third one is the individual lending model. The third one is the individual lending model. The third model is the eventually lending models, and the name suggests the her loans and giving the loan directly to the borrower. So there is no group and there is a no. So since there is no group lending, there is not any joint liability. In the if the model MFI are access the bank borrowers the credit worthiness individually, they took a loan income on the basis of the income and repayment capacity and business potentials. So this is the model serve the advantages. Loans can be customized on individual basis, individual credit worthiness basis. So the repayment schedule are flexible and great for the entrepreneurs and small business who wants to business plans. However, it's also comes to the challenges. The risk is higher because there is no group guarantee. So the liability is obviously not in that the no third party involves. The appraisal process is more detailed and expensive, and it's generally accessible only those some credit history are collateral. While this model is a powerful, better suited for the more mature microfinance markets, and the clients are already guaranteed for the group lending. And fourth and fifth is a BC model and MFI-Bank linkage. Now let's look to two very modern and scalable delivery models: the business correspondent model and MFI banking linkage model. So the first business correspondent model is also called as a BC model in the banking term. In this is the model bank appoints agents in a village level, and these agents are called a business correspondent. The cool they could local shopkeeper, post office workers, and NGO members. The BCs visits the community with the mobile device handle and terminals, and they collect the deposits and distribute the loan on the basis of the transactions and behalf of the bank. The BC acts as a mini bank and doorstep to the customers. They're extremely powerful because the banks cannot reach some areas without the cost of the building and branches. So in India, the model is regulated by the Reserve RBI, and since the major tools of the financial inclusion. The second model is a MFI banking linkage model. In this model, the commercial banks does not lend money directly to the individual borrowers. Instead of the giving wholesale funds to the MFI, the MFI then they use the money lent to the final borrowers. Think it's a pipeline. Bank sends the water to the pump and station, and then the pump station distribute the water individual to the home. The bank benefits because there it's the richest thousands of the borrowers and through the MFI without the managing to the individuals loans. The MFI benefits because it gets a large fund and low interest rate, and the borrower benefits to the because they get credit from the trusted local institution. Now here is the comparison table. Now let's do quick comparison of all 5 delivery models in the going. This is the going to very useful for the your exam. The SHG model, group based and low risk, high outreach and based on the rural women. The green model is a group of 5 people, low medium risk and high outreach based on the solicitary and group where the who known each other well, as well. The individual lending model, individual based high risk medium outreach based for the small entrepreneurs, which is the some financial background, which is has some financial background. Then the BC model, individual transaction but massive outreach, medium risk, very high outreach based the completely unbanked areas. And the MFI banking linkage model, wholesale is a nature very low risk bank, very high outreach and based on the scaling for the MFI quickly. As you can see, each model serves a different segments and context. A good microfinance strategy mix these models depending on the geography and population being served. Here are the key takeaways. Let's quickly summarize what we learned today. First, no single delivery model for all situations. The base model depends on the local context and the type of population capacity institutions. Second one, the effective delivery model must achieve the 4 goals: reduce the cost, improve outreach and control the risk, ensures timely credit. Third one, group model is the like SHG Grameen use power commodity, peer pressures and may lending to the without the traditional collateral. And fourth, the technology driven model like BC models and future microfinance, they allow us institutions for to scale massively to the very low cost. And I hope this is the video give you the clear and complete understanding about the delivery models in the microfinance. If you found it is helpful, please give this video to the thumbs up, share with your friends and subscribe the channel so you never miss the future videos. Thank you so much watching. I will see you the next one. Take care.